Great. Well, welcome everyone to our first Ask a VC webinar. I'm Kirsten Loita of Osage University Partners, and I'm going to be your moderator today. I call this our first Ask a VC webinar, anticipating perhaps that if this is something that the attendees enjoy, that we may be doing this again sometime in the future. So today's webinar is a session where our partner technology transfer offices can ask OUP managing partners Marc Singer and Bill Harrington anything and everything as it pertains to venture capital operations, decision-making, and investing in university spinouts, as well as the current investing environment, a topic we know that's probably on everyone's minds. Many of you already know our panelists, but I'll have each of them provide a brief introduction to themselves. Marc, you want to start?
Yeah. Hi, everybody. I'm Marc Singer. I'm a managing partner, and I run our technology investing practice at OUP. And I've been in the venture industry for over 25 years at this point, which means it includes multiple recessions. And so I'm a co-founder of OUP and I started working on it with Bob Adelson and Luke Burnham back in 2007, and we formally launched OUP in 2010. So I'll turn it over to you, Bill.
Yes, and my name is Bill Harrington. I'm also a managing partner here, and I manage our life science investing activities. I'm a physician originally, was in the Bay Area and was corrupted into venture capital about a little over 20 years ago, and was a general partner at 3 Arch Partners on Sand Hill Road. Came out to Philadelphia to work with Marc and Bob to get the life science activities spun up on OUP just about 8.5 years ago.
Great. So thanks in advance to both of you for sharing your experiences with our audience today. Zoom toolbar probably at the bottom or the top of your screen. So lastly, due to all of our recent webinars currently going over time, over the 1 hour that we typically allotted, we have extended this webinar by an additional half an hour. If you have to drop off at the hour mark, that's fine, but we're recording the session that as I mentioned earlier, so you can watch the rest at a later time. So now that we have the administrative part out of the way, we're going to start with a brief overview of OUP and answer any OUP specific questions that you may have. Marc, do you want to take it away?
Sure. Thanks, Kirsten. So hopefully most of you on the call already know way too much about OUP, but for those of you who may be newer to us, we thought we'd just spend a minute giving you a little bit more detail. So we're a venture capital firm, but a different kind of venture capital firm than most VCs out in the marketplace, in that we partner entirely with universities to invest in their spinouts. And the nature of that partnership is such that a university provides to us follow-on participation rights that it has in companies that have licensed technology from those schools, and we exercise those rights and share our profit back with our universities. So hopefully we've created a symbiotic partnership where we get access to great university spinouts, and our universities who historically had follow-on investment opportunities in their own spinouts but did not take advantage of them can share in our profit. So given that model, we invest in a wide range of spinouts. So first, it's a wide range of sectors, including everything on the life science world, and Bill will go into more detail on that, as well as a broad range of tech sectors that I'll talk about. And then also we invest in a wide range of stages. So we'll invest in seed rounds, Series A rounds, but all the way through Series D or Series E rounds. And that's reflective of the fact that our partner universities have companies in all of these different sectors, in all of these different stages. So you'll often hear from us, we want to hear about any company, no matter how early or late, no matter the sector, because we want to at least know about it so we can begin to engage with those companies. So we're very broad. We also have spent a lot of time and effort and investment in building up programs for our partner universities. So they not only benefit from our profit when we invest in their spinouts, but they also participate in a broader range of programs, such as this webinar. And so Kirsten runs our university relations team, and she has built both a great team and a great set of programs that help our tech transfer office partners be better at creating new startups, helping them get funded, finding management teams, and then also we share a lot of data and insight. And so hopefully our partners value the programs that we have and hopefully are better for them. And then finally, we've been at this for about 10 years. So we ourselves were a true startup about 10 years ago, and a small handful of universities took a risk on us and partnering with us. And we've now gotten to a point that we've raised 3 funds, about $600 million across those 10 years. So we most recently raised our 3rd fund about a year ago, and it's a $273 million fund. We've invested in about 100 university spinouts, and so far have had some good success with 19 IPOs and some great acquisitions as well. So, so over the 10 years, we've definitely grown the enterprise, and hopefully look forward to investing in many more of your spinouts in the future. So with that as an overview, I'll turn it over to Bill to talk in a little bit more detail about our life science investing activity and what we're looking for, and then I'll do the same about our tech investments.
Thanks, Marc. As Marc mentioned, with respect to life science, is no different in the sense that we look at pretty much anything you can imagine emerging from a university research lab. In life science, it really breaks down into 4 major buckets: therapeutics, medical devices, diagnostics, and research tools. I'll leave healthcare IT as kind of in the netherworld between tech and life science. When you think about venture-backed companies in life science, in each of those buckets, in therapeutics, the vast majority of those companies in biotech and biopharma originate in a seminal discovery made in a university research lab. There are some spinouts from pharma and some orphaned assets and the like, but by and large, the thick part of the bell curve in venture biotech really traces its roots back to university research labs. That's not true if you look at the thick part of the bell curve in medical devices, where most venture-backed medical device companies are started and conceived of by physicians and engineers tinkering and trying to figure out real-world problems, as opposed to a hypothesis-driven research discovery in a research laboratory. Sometimes that is the case, but really the bulk of medical device technology does not originate in universities as opposed to biotech. And then research tools and diagnostics tends to be more in the middle. You see a lot of research tools around cell therapies and the like, and diagnostics across the board. Both of those sectors have been very difficult to invest in for venture capitalists over the past several decades. For diagnostics, it's relatively easy to get a test approved, particularly in LDT. Getting it reimbursed is another story. That's where most of those companies run into a brick wall. And for research tools, finding a broad enough market opportunity has been challenging. It's not impossible, but difficult. The vast majority of our investment really falls into biotech, biopharma, therapeutics. So small molecules, biologics, cell therapies, and the like. We have made some investments in medical devices, and we'll continue to look at those going forward, but 85+% of what we have done in life science has been in biopharma. And we look at all sectors and stages. As you're all aware, these participation rights don't expire if unexercised, so we are looking at not only brand new companies emerging from university labs raising Series C, Series A financings, but later stage companies that are raising, follow-on Series C, Series D, mezzanine, even recap financing. So as far as sector goes, we're very, very broad. And as far as stage goes, we're very, very broad. As far as sector goes, we're broad, but we also mirror the broader venture community, which focuses very heavily in therapeutics.
Marc, do you want to go with tech?
Thanks, Marc. Yeah. So to give you a little bit more detail on our tech investment practice, from a sector standpoint, it really breaks down into 3 categories: software, hardware, and everything else. And on the software side, kind of areas of interest for us within software are cybersecurity, infrastructure software, AI and machine learning. And so most of our investment activity falls on the software side, falls into one of those buckets. And in general, software is about half of our tech investing activity. And then on the hardware side, there we invest in a broad range of areas that include semiconductors, IoT, robotics. We've made 2 quantum computing investments. And then in the bucket of everything else, that would include materials, energy, and kind of a smattering of other categories that you commercialize technology in. So it really winds up being quite broad. And then from a stage standpoint, we will do seed stage investments generally in software, but we generally won't do seed stage investing in hardware or other areas, just given the time it takes to get to market being so much shorter with software as compared to other areas. And so you'll see us do some seed investing where we will work with a professor, perhaps help them find a CEO, and start to build a company from scratch in the software world. Outside of that, then we generally are, most of our points of entry on the tech side are fairly early at Series A rounds, although we'll talk more about the COVID environment. In the COVID environment, we are looking at some later rounds as well. So that's a little bit more detail on our tech investment practice.
Great. So we have a few questions that are specific to OUP. So one is that what are specific criteria that define the baseline for OUP to even consider investing in a company?
I could probably take that. So we have a fairly broad mandate, just to make it clear. We look at lots of different opportunities and even early technologies that we can help fashion into the components that would be suitable to form a company around. But that company formation activity is not really where our sweet spot. Generally, we're looking to invest in a company that has a management team and has a business model and a business plan. And as Marc said, and this is particularly true in life science, where the capital requirements tend to be so great, we look to be able to syndicate. So what we're looking for in terms of fundamental pieces would be, a business plan, a business model that incorporates some translational work around the original research discovery to convince us and other investors that there's a commercial opportunity. How do you take a discovery in a lab and turn it into a business? And then there's got to be a path forward, both in terms of incremental risk reduction through serial financing efforts and value inflection points that you can finance to along the way. One of the hallmarks of any kind of venture-backed company is the ability to incrementally retire risk, as opposed to, for instance, a company where you really don't know if it's going to be successful or not until you've put a lot of money into it. In venture, we're trying to kill companies as quickly as we can and trying to do that with as little money at risk. So I think one hallmark of an investable company is the ability to incrementally reduce risk with incremental investments over time. And then, there's got to be a need for capital to quickly scale the business and to achieve an outcome that would provide risk-adjusted venture-like returns, which sometimes can seem pretty massive, but you have to realize we are looking at these investments, as are other VCs, in the context of a portfolio where some companies will fail, some will succeed, and the successes have to not only make up for the losses, but generate attractive returns for the entire portfolio. So getting into particulars, I think you need that fundamental piece of technology that's got great commercial application, that fits into a competitive landscape where the new technology or the new discovery is truly differentiated in a meaningful way, not just another version of something that exists, but is truly different, that solves a clinical or technical problem that has been difficult to solve to date, that has a defined customer base. And in tech, I'll let Marc address that more specifically, but in life science, are there patients, physicians? Is there a point of contact in a way you could deliver a therapy to the clinic? Are these patients seen by certain physicians? How does this new technology fit into that? So you need to have access to the market. Tech, they call it product market fit. In life science, it really has to match practice of medicine in some fashion and existing physician behavior. It's very hard to change that. And then the question is, how much money will it take to get this technology or discovery to a point where as an investor, we could achieve liquidity. We can do that through an IPO. Once companies are public, we have the ability to sell our shares over time, or for the company to be acquired by a larger organization and achieve liquidity that way. So for us, one of the questions we and other VCs ask is, what will it take to get to a point where we will be able to exit a company? What would the company be worth at the time we exit it? And when we look at the money it takes to get there, is there a multiple that makes sense in the context of a broader portfolio? So capital requirements, value inflection point, and ultimate value are all very important. And then the question is, who's going to take us on the voyage? Typically the university spinouts have faculty founders who are not leaving their day job, and generally it's a good thing. The skills required to run a startup from the early days of company formation through fast growth and into more sophisticated development stage are skills that most faculty members don't have and won't develop. So we'll see that. We see that as an important aspect of how do we find a team to take this company forward? Do they have a team? Have they identified people to do it? At OUP, we spend a lot of time evaluating management teams. We can help bring members to teams. We can help fill out teams, but that's a critical piece of the equation as well. And then you get into some of the more technical issues around IP, freedom to operate, defensibility, and the like, which at least for us are very important, but fall into kind of the second tier of issues that we look at once the others have been satisfied. Marc, you may
Bill,
want
before we move on to Marc really quickly, is there certain data that you like to see as far as proof of concept data, et cetera, in a drug startup before we will invest, or does it just vary on all the other factors?
Is that for Marc or for me?
That's for you, Bill. Just as far as, particularly to a drug startup. But Marc can answer it for the tech side.
Yeah. So there's always this question of a new in university research, a new biologic pathway is discovered, and in the
Is Bill frozen?
I think we've lost Bill.
Okay. Yeah. Marc, why don't you go into your side?
Yeah. And do you want me to answer the question about data, like what kind of data we're looking for?
Right.
Yeah. So, well, in an ideal world with an early stage company, this obviously, the answer depends on the stage of the company. Ultimately, the data you want to invest behind or have your investment get you to is revenue that's proof of customer acceptance. Because really what you want is to know that you have built a product that the market wants. And that's in particular a challenge with physical science university spinouts that often start with great radical technology and then try to figure out what product to build and what problem to solve. And so what we're always looking for is data to say that that company has taken that great technology, turned it into a real product that the market wants. So the best data around that is that customers are paying for it and renewing. And so in an ideal world, you would only invest in companies that had that, but that's unrealistic. So most of the companies we invest in never have that, don't have that, and we're investing to try to get to it. So if you back up from that, then what you'd like to have, if you don't have kind of revenue and repurchase and renewal history, is you'd want proof of concept data, that they've done POCs with a handful of customers, let me call it 3 customers, and those customers like it and are ready to buy, have either bought or are exploring buying. If you back up from that, because if you're going earlier than that, often you don't have POC data, what you then have are potential customers who have engaged with the product and think it's interesting and want to move into POCs. And then that's kind of the earliest piece of actual data that you could get that could give you any sense of kind of what's going on. And so we invest frequently in companies that just have that have lots of customers who want to move into a POC. We often are trying to connect prospective investments with corporate customers who could move into POCs, and then we're talking to them and trying to understand what's the value proposition to them, how much might they be willing to pay, what kind of results they need to see, and part of the kind of art of venture investing is trying to figure out how sticky is that, like how reliable is that information.
And so that's one side of the equation, but also when we're looking at investments, obviously, a lot of what we're looking at is the team itself. And I know Bill already talked some about this, but Marc, do you also want to talk about it from the tech side about the importance of the team?
Yeah, if you look at the number one reason we turn down investment opportunities, it's because of the team. And you might be able to say it's kind of number one, number two, and number three combined. So it is far and away the most important criteria for us, and also the most important component of success for successful companies. So there's a lot of data around this, around failed companies, how often investors believe the management team was the reason for the failure, and also successful companies, how often they believe management team was responsible for the success. So fundamentally, we're in the business of picking great teams, and it can be hard to have a great team at a really early stage with a university spin out. And so so we're looking for a great team, but no, it might often not be there. And so our first choice is to have a great CEO who's partnered with a founder who's an academic, and the academic founder doesn't want to go to the company full time, or perhaps wants to be in a technical role full time, and there's an outside CEO. But it doesn't happen all that often that you find great CEOs willing to engage at that stage. So that's the best situation for us. The worst situation for us are one of two situations. Number one, an academic founder who wants to be CEO at all costs and wants to prove themselves and believes that they have the intellectual capacity to learn how to be an entrepreneur very quickly, and they don't realize what they don't know. And usually they wind up making too many mistakes along the way. So that's a barrier for us, and often a knockout factor. Or secondly, if there is a mediocre CEO or mediocre management team in place, because that's also a blocker to getting somebody good in place later. So the best situation is a great team. The worst situation is an academic founder who is determined to be CEO in the medium term, or a mediocre management team who is also determined to prove themselves. So in the middle, which is where most startups we are okay with the idea that there's an academic founder who is an interim CEO, who is willing to run the company until we collectively find the right CEO. And we're also okay with an interim outside CEO who's comfortable being interim until we can find the right outside CEO. Because in those situations, there's not a blocker, there's not an impediment to bringing in a great team in 3 months now, or 6 months, or 12 months. So having interim teams that are willing to step aside, whether it's an academic team or a non-academic team, that works generally pretty well. And I think the venture world has gotten more comfortable with that. Having management teams in place that want to prove themselves, that we believe up front are not great, that's usually where there's a problem.
Great. So one of the questions that we had come in is actually about these, they know that, everyone knows these teams and the team skills are really important as far as to startup companies, but how do they actually find the people or teach the skills to successfully build companies and appropriately attract investments? It's perhaps especially in those non-larger, markets, the markets that everyone knows so well, Silicon Valley, Boston, Cambridge, RTP, et cetera. Do you have advice in those areas?
I'll start, and then Bill can jump in. So kind of the best way teams are formed is almost through kind of serendipity and introductions, where an academic founder finds their own CEO that they are connected to. And it could be through us or through other introductions. So usually kind of the PI teaming up with someone in a true partnership way is kind of the best approach. And often it happens through serendipity. They met somewhere, or they were introduced, or the PI's network connects them to an operator. And so if anything you can do to foster that development is great, but that's hard to do. And then so the question is, outside of that, what can you do? A number of our tech transfer partners are always cultivating talent in their ecosystem, not for a specific project, but in general. And so they have a stable of people they know that they can start connecting in the startups. And the truth about connecting potential entrepreneurs to potential startups is it's a low hit rate activity. You need to generally need to make a lot of them to find something that sticks. And we've seen that in our own work. Also, there are platforms like AVX out there that make connections and that are valuable, but it's a low, each individual connection is a low probability of success. So you need to make a lot of them. And so the key is to put the academic founders in a situation that they can connect with the marketplace in lots of different ways, through VCs, through the tech transfer office building their own stable of entrepreneurs, and through their network, because it takes kind of hustling to try to find the right people. Lastly, I would say there are kind of the internal networks within the university that some of our universities mine pretty well, the alumni network, the business school network, and so sometimes those can be sources of candidates as well. Bill, do you have anything to add to that?
I think with life science, there's a couple things I'd add. One is that oftentimes there's a series of translational experiments that you need to do. And first of all, you need to identify that given the underlying discovery, if these three things are true, this could be really interesting as a company. So number one, it's identifying those translational experiments and then carrying them out. You could either do it in the academic lab. What we and other VCs like to do is have that work done or replicated in a more commercially robust CRO. And the question is, how do you define those translational experiments? That's where, talking to entrepreneurs or individuals who have experience, with startup activity and taking technologies forward into a venture-backed ecosystem could be very, very helpful. Talking to some VCs would be helpful. We tend to try to do what we can to answer those questions. But really, in almost all cases, there's a series of additional experiments that would be outside of the fundamental research trajectory that are required to really embark on a commercial opportunity. And it's figuring those out. You don't need a CEO. You just need somebody to help define what those experiments are and what the answers are that potential investors would need to see.
Great, and I'm gonna ask one more quick question just on OUP, and then we're gonna move on to the current investment environment. We have a lot of questions already from the audience besides the ones that were sent in. So we're gonna work on getting through all of these. So if we don't answer your question right away, just know it's coming down the line and we're going to get to it. Marc, really quickly to you, when reviewing a startup or technology or team, does OUP provide the university insight on why OUP may not fund the particular company? And I may add a couple of things to this when you're done.
Yeah, we aspire to, but it also, given the number of opportunities we look at, I would say we're not always perfect about remembering to communicate out to you, our partner universities, exactly why we passed on something. So if ever you want feedback, and we've looked at something, please approach us, or even if we haven't talked to them yet and you want our feedback, feel free to approach us. We want to provide that feedback to you. I would say one of the things we've tried to do with smaller cohorts of our partner universities is actually be more deliberate about helping them understand how we evaluate management teams specifically, because we're often saying to our university, we're not investing because of the management team, and they would say, well, why is that? They look great on paper. And we would go through this long discussion. So we actually have a webinar on this, and we've given some other talks around how we evaluate management teams. So if you're ever interested in that, you could email us and we could provide you some of the content around how we do think about teams.
Great. Let's move on to the current investment environment question, because we actually have a number of questions already from people on that. Let's go through kind of your thoughts that you already had that you were going to prepare for this, and then through some of the questions that have come in on this as well. And again, I've just promised everyone we're going to get to the other questions you've written into.
Sure, and we'll go through this pretty quickly. I mean, I think the question on everyone's mind is kind of what's going on right now, and we're all trying to figure this out at the same time. So we are asking ourselves that question every day. And so, first I'll give a quick overview of what we've seen happen in the last few months in the venture economy. I don't think any of this will really be a surprise to you. First, I would say there was kind of inertia on the way into the pandemic and the financial crisis, meaning deals that were in process prior to the pandemic and the quarantining that followed generally closed. Every once in a while, something renegotiated, but most things that were in process closed, which was good news. And usually in the entrepreneurial world, there's kind of inertia where things in process continue to move in process. What has changed is engagement by VCs on new investment activity. It started slowing dramatically. We'll talk a little bit later. We think it's starting to pick up a little bit, but we saw more companies just kind of stop trying to fundraise at all, or existing investors step up and fund around because they didn't think they could raise money on the outside from new VCs. So new investment activity has definitely taken a hit. The key question is, how long does that last? On the corporate venture side, a lot of you work with corporate VCs, we do as well. There have been a wide range of behaviors. Some corporate VCs have categorically shut down everything. So we had companies that were raising capital from corporate VCs where there was a mandate from the CEO's office saying, stop all investing and cut all expenses 20% across the board. Other VCs have continued to move forward. You know, we have 2 of our companies right now in serious engagements with lead strategic corporate VCs. So there still is activity. It depends on the VC. And then on the startup side, as I'm sure you've seen, like all of our startups are focused on how can they take their current cash and make it last as long as possible. Unfortunately, there have been reductions in force across many companies. That's happened more on the tech side than the life science side, and lots of salary reductions and furloughs and doing whatever it takes to make sure the company survives. And we've seen, like within our portfolio, we've been lucky. Just about all of our companies are in good position financially and have enough capital. They've had to make some hard decisions to make it last, but for the most part, things are not in terrible shape there. And then last, you've probably maybe engaged with or seen in the media lots of talk around the Paycheck Protection Program, the government program. Lots of our companies explored that right up front. A large number of them ultimately have decided not to take the capital because they've wound up feeling like they had enough capital to last without it. Some have taken the money, but there's been lots of mixed points of view on that. So why don't we go to the next slide? And then in terms of what we expect over the next year or so, again, we are guessing as much as anybody. So we're all becoming epidemiologists and economists and social psychologists at the same time to try to project what's really going to happen here. We don't know. We believe it's going to be long and deep, and our orientation is that we are that the pandemic and the recession will take a long time to play through. And usually, you know, when there's uncertainty, people freeze up. We already are starting to think about how, if we know it's going to be long, how can we invest actively during that time? Other investors are doing the same thing. So we're starting to see people pop up and say, how can we be more active in this kind of new normal? In terms of what we're seeing in our portfolio and in the entrepreneurial economy at large, great companies are continuing to get funding. Average companies are the ones that are struggling. And so if the company's doing well, has great promise, usually they can raise capital, sometimes even at really premium prices. And it's the companies that haven't proven their greatness yet that are at risk. We've also already seen valuations come down. It's happened more dramatically at the later stages. Later stage companies are generally more closely tied to public market valuations. So as the public market has come down a lot, later stage valuations have come down. And so we do think there'll be some decrease in pricing around later stage rounds. We have seen a number of VC funds who have deployed a lot of capital into a lot of companies, and now as those companies need more money, those VCs are under-reserved and have to triage their portfolios and potentially cut off some companies. We're fortunate at OUP, we don't have to do that, so we have plenty of reserve for every one of our companies, but that's starting to play through in the market. And then the last piece of it is, like, we're all thinking about how do we invest in a world where we're no longer going to be able to meet the management teams face to face. And so we ourselves at OUP are thinking about how do we do virtual diligence? How do we find new ways to evaluate management teams that are different than our previous ways, because so much of our previous methods relied on in-person evaluation. And we do think there are some ways you can use video to your advantage. So we're starting to ask that question a lot. And then to go on to the next slide, so we can get back to your questions. So, you know, specifically on the tech side where I focus, if you look in our tech portfolio at all of our companies and say how they're doing, first I'd say kind of the best companies are continuing to do well, but they're growing a little bit less fast. So companies that were growing and growing well are continuing to grow, but just at slower growth rates, and that lags a little bit. So most of our companies had strong first quarters. They may even have strong second quarters. It's the second half of this year that is really uncertain right now. And so as we're thinking about our portfolio and new investments in companies that are generating revenue already, the question we have is what's the range of possible outcomes in the next 6 to 12 months, and how do we kind of create a deal structure really that protects against that. And then in terms of specific areas, cybersecurity within our portfolio has probably benefited more than it's been hurt. It's been hurt also, but it's probably had more benefit. And as cybersecurity has become increasingly important, also our companies that sell to government customers have also done quite well. So that's been attractive. Also increasingly around automation and robotics, while there's short-term problems because nobody's going to expend capital in terms of CapEx, long-term we think there's some bigger opportunities there. So those are some of the areas that we're thinking about. And then lastly, I'd say one of the unknowns for us is kind of what happens between the US and China, politically and economically, as it relates to technology purchasing. So it's possible that Chinese companies may only buy from Chinese companies in the future. US companies may only buy technology from US companies. There are pros and cons economically to that. And so we're still trying to figure that piece out. So with that, I'll turn it over to Bill to talk about kind of what we're seeing with COVID regarding the life science side.
Yeah, the life science side, it's really a tale of preclinical and clinical activities. For preclinical work, as many of you know, the university labs, most of them have been shut down. And so any work going on there has ceased. The company-owned labs have been able to operate under a biotech exemption in most geographies. So with appropriate precautions, they have been able to continue to make progress. Generally, they've split their teams into 2 or 3 shifts for longer days, but with fewer people in the facility at any one time, and lots of other measures to try to reduce any risk from COVID, but they have been able to make progress. The CROs, originally the CROs in China were shut down. They have come back online a month or so ago and are now at or even above earlier capacity. And we have had variable impact on preclinical CROs here in the US. Some have continued on with business, if not as usual, on schedule. And some have reduced activity and some have closed. But we're starting to see the ones that have cut back or closed come back online. So preclinical activity has generally been steady. The clinical studies, though, particularly those at hospitals, but also at ambulatory surgical centers and the like, they have all largely stopped. And, with enrollment stopped there, those companies are struggling a little bit because they have the infrastructure and the teams to try to enroll patients and monitor patients going through clinical trials, which now they're not doing. So they're trying to figure out how to husband their cash. For many of them, as Marc said, at least in our portfolio, they have the money that they need to finish the trial. It may just be 1 or 2 quarters delayed. The bigger impact are the trials that are already underway, patients who have been treated and require scheduled follow-ups, lab tests, blood tests, and the like. And, to what extent those schedules are interrupted, what impact it will have on the validity of the data and the statistical analysis of those data, and how the FDA will respond to these kind of interrupted patient trajectories. And the FDA is working with companies now trying to figure out how to manage that. But I would say the clinical trial disruption is probably the biggest issue. And as hospitals are now starting to reopen, they're trying to reschedule deferred non-urgent surgeries and bring people back. These trials will start enrolling once again. And we've seen that in our portfolio. So I think overall the impact in life science has been meaningful, relatively transient. And, who knows whether there'll be a second wave or what will happen in the fall, but at least as of now, things are moving, in a more normal direction, certainly preclinically and even clinically.
Bill, I have another question for you. This is one from the audience. Does VC activity during the last financial crisis in 2008, 2010 provide any insights or lessons for us today?
You know, it's interesting. We were kind of debating that early in the course of this crisis. And, you know, in the 07, 08 financial crisis, the problem was nobody had money. So you couldn't raise money. It was hard to you know, even if you had a good technology, it was hard to get it financed because there was little risk capital around. Here, it's just the opposite. You can have plenty of capital, but you just can't run your business. And you can't invest it because the companies you're investing in can't prosecute their technology. And what we've seen, I think, across the venture ecosystem is, you know, most VCs, and ourselves included, looking at potential investment opportunities in the context of COVID and saying, this is very interesting technology, this is a great management team, checks all the boxes, but right now the company is forced to be dormant. And we don't really want to invest our money and have it consumed by a company that has a base burn rate that isn't making any progress. So the difference, I think, between the two in terms of behavior is VCs would love to invest in these companies as soon as they can see them able to get back and into various value creating activities. In the last financial crisis, you know, there was limited visibility on exits. VCs were worried about raising money for their own funds. And it was more of a purely financial issue that even with a great company with great technology, great management team, there was no way to fund them. And if you could fund them, you were worried about what they'd be worth in success. So the concerns, I think, are quite different.
Great, thanks. So another COVID pandemic related question is about actually building relationships with venture capitalists. Is now a time that this can be pursued, considering that there's no meeting in person, et cetera? Is this something that people can do? What are the ways that people can actually go about potentially deepening their relationships with VCs right now? And actually, Marc, I'll address this one to you.
Sure. So I think it can be done, but I think you have to have a certain mindset around it that you're relationship building more than you are making an ask right now. And so it's hard to kind of engage with one VC, get them to deeply engage with a startup, move that to term sheet and exit like this. The probability of that happening with any one relationship is lower right now than it was maybe 6 months ago. It's not impossible, but the probability of getting a VC's attention now might be a little bit higher. So nobody's traveling. People have more time. Their schedules are a little freer. It's actually easier to get on people's schedules. We found things that we used to have to schedule a month in advance. We could schedule 3 days from now. And so it's possible you can use this to relationship build much more so than you could have 6 months ago. And I would recommend doing that. And so if you were to email, let's say 10 investors now and try to set up calls to build a relationship, my guess is maybe you'll get 2 or 3 to respond. But that would be higher than perhaps a while ago. And then start to build a relationship with them where you're not making a specific ask today, but you may 6 or 9 or 12 months from now. And so I think that is valuable. And so I would encourage you to do that in the hopes that maybe you'll find somebody who is interested in doing a deal down the road.
And Bill, for those companies that were perhaps anticipating going out and raising rounds, especially those who had not yet raised, like they were actually going to go out and do their first rounds, et cetera, what do you advise them right now? Should they be going out, making at least these contacts, et cetera? What should they be thinking about as far as potentially looking at when they may be able to raise those rounds?
So for a company that's not raised money before, I'm assuming these would be preclinical, for life science anyway, preclinical stage companies. You know, generally they will need to have a plan and an answer to the question of how are you going to advance this technology in the current environment. And if it's, well, you know, my academic lab is closed, but we think it's going to reopen in the fall, probably not going to work. But if there's a way to continue the work in a third-party lab or a CRO, or tell an investor, hey, I will take your money and put it to work advancing my technology, I think that VCs are very open to that. As Marc mentioned before, something we and others are struggling with is how do we do diligence in a world where we can't travel as freely, and we're stuck with Zoom calls and video interactions and the like. And I think investors are realizing that they're just going to have to figure out how to make this work. But you have to have an answer to the question, how are you going to advance the ball in a COVID constrained environment? And I think for a preclinical company, there are a lot of ways to do that. So I think it's not a bad time to go raise money right now.
Okay, great.
The thing I would add to that is, because we've closed since COVID started, we've closed one new investment, and we're looking at some others. And a key question for us once we got comfortable we wanted to do the deal was, what is the burn rate of the company until things return to normal? And so the idea of having a company where you're paying a full team, where they're at half capacity, that's not a good use of funds in this environment. So any company that's going to raise money today needs to figure out how do they manage a really low burn until they get to the point that things open up a little bit.
All right, I'd like us to potentially move on from the pandemic questions to the venture capital structure and operations questions, if you guys are okay with that now. We have a lot of questions from people, so I'd like to get to some of these. So one of the questions that was sent in to us early on was just give a description of what the definition of an official round is. What open and closes a round of investment in a startup company? And also, what's an extension versus a new round?
So there's a couple ways venture investors invest in companies, or venture-backed companies raise money. There's the round, which is typically an offering of a specifically defined security. In the case of venture capital, it's usually a convertible preferred stock. It can be common stock. But a round is typically a certain amount of money raised to buy a specific investment instrument or shares. And that is funded by one or several investors. And there's a date, there's a term sheet that's put together that describes the offering. And, the investors subscribe to that, they buy shares. And then there's a closing date at which point the monies are allocated and the monies come in and the financing's done, and the company now has a valuation based on the percentage of the company that was bought by the new shareholders for what price. And there's a capital table, a cap structure, so that you know who owns what. Typically, the shares that venture investors buy, these convertible preferred shares, have various advantages over common stock in terms of liquidation preference and other protections, so that there is a kind of a structured order to the capital tape, to the cap structure, where certain investors, certain shareholders have advantages, or paid first or paid more in different scenarios. So you kind of build that, but that would be a round. We also, and investors also invest in notes, in convertible notes and safe notes, which are essentially loans to companies that can convert into shares of a financing if one were to occur. If not, there's a repayment schedule that is defined. That's another way companies can get financing. And an extension is basically when you have a round of financing that's been completed and the company needs to raise additional capital. They have a couple options. One is to raise a new round, say we're going to sell shares to investors. We need to raise X dollars, and we are looking for investors to put money into the company. Usually the investors set the price. Sometimes the company tries to set the price. An extension is saying we are going to reopen our last round at the same price and terms and just bring in more money under those conditions. And that is easier to do. There's, the existing investors in that scenario would be a little bit less inclined to do that, because new investors are coming in on the same valuation, assuming the company's made some progress. The time value of money is something that should be considered there. but that is another way to raise money, is to open a round. Typically, it's for a small percentage of what was raised initially. You wouldn't do an extension and raise the same amount, for instance. Typically, the company is not in a position to go out and raise a new round at a higher price for any one of a number of reasons. So I think the extension is an option if you need to raise a little money. Typically where we see extensions employed is when companies raise a round and then as they get to work deploying that capital, realize to achieve the objectives they initially set out to achieve with the original round, some assumptions are incorrect, or something turns out to be more expensive or take longer, and they need more money to reach that inflection point where they can raise money at a higher price. So it's really getting from point A to point B. At point B, you can raise money at a higher price. If you misjudge that with the initial investment, and that happens a lot because these are all voyages of discovery to some extent, you know, extending around, either raising it from the existing investors or bringing in a new investor is a viable strategy.
Okay, great. And Marc, what's a rolling close?
Yeah, a rolling close is something you do where at the first point you're taking money in, it's not all the money you want or not all the money you need. So you would close on the amount you're taking in, and the term close means you're signing documents and wiring money. But then you're keeping the round open, so as you get more money in, you close on that. So every time a new investor says that they're willing to invest, you take that money. And that's why it's called rolling. It continues like a wheel rolling. So you don't have a single close, you don't have two closes, you have a closing every time a new investor is ready to write a check. And the benefit of that, the negative is obviously you haven't gotten all the money you wanted up front. The positive is the moment you have an interested investor, you get that money. You close on it and you don't leave them outstanding until you get enough future investors. Okay. So funds often have rolling closes where they will keep closing over time.
Mm-hmm. We have a question here, and I'm not sure how you'll answer it, but one of the questions is, what is a fair cap table from a VC perspective? Is that something that you can answer just off the cuff like this, or is this something that you need to know more information about?
You know, the cap table shows really who owns what in the company, what the ownership of a company looks like. And in a venture-backed company, it's usually preferred stock and common stock. And oftentimes, if a company is raising capital under duress, the preferred investors will have lots of bells and whistles on the preferred stock that give them multiple liquidation preference options and lots of things that, you know, when looked at in a certain light are unfair and really favor one shareholder group over another. But when looked at in the light of, well, what were the prevailing circumstances at the time the company raised the money, may look just fine, because in order to raise the capital, the company had to surrender, previous other shareholders had to surrender certain rights to the new shareholders. So I think it's very hard to look at a cap table a priori and say this is fair or unfair without understanding the circumstances under which it was developed.
Okay, thanks. Marc, do you have any, the question here is, do you have any preferred business plan templates or examples that you are able to share? I'm not even sure if you see business plans themselves these days. Maybe you can answer that, what you like to see from the company to really understand its business.
We never see written business plans anymore. They have completely disappeared to the point that it would be old-fashioned. Even though there was something good about having to write stuff out, it would seem old-fashioned at this point for somebody to have a written business plan. So everything's done in PowerPoint or some presentation version. And you know, the keys for us are, number one, to lay out clearly who the management team is. I'd say oftentimes that's buried later, or sometimes surprisingly not even in an overview deck, and that should be right up front. Second, obviously you have kind of what's the technology, what's the product, what's the market. And then the last piece that's often also left out is the financial piece. How much capital do you need? How far does it get you? what value creation points does it get you to? And that's it's a good discipline to be forced to go through anyway, and very important to have that in any overview deck.
Okay. Marc, I'm going to direct this next one to you as well. SAFE agreements have been controversial as an investment vehicle, particularly in the company's ability to raise funding in future rounds. Do you have any thoughts on this particular topic? I know that in the tech area, SAFEs are more common. And also this person asks, should academic institutions consider SAFE agreements in lieu of equity or convertible notes?
Yeah. First, let me describe what a SAFE is for those who don't know. It stands for a simple agreement for future equity, and it is very similar to a convertible note. And in both cases, whether it's a SAFE or convertible note, what you're doing is investing in a company, a certain dollar amount, and having that dollar amount convert into a future equity round of the company. So let's say we invested $1 million in either a SAFE or a convertible note. Then when the company raised a $5 or $10 million equity round that had a price, our SAFE or convertible note would convert at that future equity round, usually at a discount to that price. And so the reason it's used is to avoid having to price the company today and say the company is worth X today. And so what the SAFE note investor is saying is, we're happy to have you go raise money in the future, and if you raise money 12 months from now, we want to just get a 20% discount to that, and we'll convert at that price. So it's a way to get rid of a lot of the negotiating and haggling that happens, and it's often used by angel investors or seed stage investors, and sometimes by strategics. So that's the general principle of it when you can't assign a value today. Now, the question is kind of specifically about SAFE notes in particular versus convertible notes. So going back a few years, Y Combinator popularized the SAFE note as a different structure than a convertible note. A convertible note, which did exactly what I mentioned, is in fact debt. And it sits on the balance sheet, and other vendors look at it as debt, customers look at it as debt. And so for certain reasons, people didn't want it to look like debt. And so they created a SAFE note, which no longer looks like debt, primarily because it doesn't have interest attached to it. So it's very similar, but doesn't look like debt. But it functions pretty similarly, and a lot of the tech world has embraced SAFE notes. We do SAFE notes, and or we'll do convertible notes. We don't think it really matters. So I don't think on the tech side there's been that much controversy around it. I think it's fine. The key question is, are you comfortable investing now where you don't know what the price is going to be? It'll be something in the future. But I happen to think that they're a perfectly good structure, and we use them. Now, the last question of should tech transfer offices take SAFE notes as compensation in a license? It is hard because what you have to do is assign a dollar value to your contribution. So the reason with a SAFE note or a convertible note, you're putting in $200,000, you get a $200,000 SAFE note. What's hard for universities is how do you quantify everything that went into supporting the research, filing for patents. So it's hard to come up with a dollar amount. So I would say only in very rare circumstances have we seen our partner universities use more convertible notes than SAFE notes in transactions. And it's usually when they've actually had to put out some real dollars for something. They've had to waive a very large patent reimbursement. And they say, okay, well, instead of paying us $50,000 or $100,000, give that to us as a note, or whether it's a SAFE note or convertible note. So if you have a big outlay, I think, and you can't get paid back, I do think it's an okay way to try to get compensated in the future for it.
Great. I'm going to ask this next question to both of you. Maybe you can give quick answers on this, what you think the answer is, but I think it's also a tough question. So Bill first, what is the most important aspect of a company structure which makes it VC investor friendly?
Well, most of the venture investments that we and other VCs make are into C Corps in terms of corporate structure. Whether the company is something else when we first encounter it, we will turn it into a C Corp in most cases. So just, I think, it doesn't really matter. Just be prepared that as part of institutional financing, the company may be restructured into a more traditional C Corp.
Okay. Marc?
Same thing. And I would say sometimes companies get wound up on trying to protect tax losses for angel investors by being an LLC or an S Corp, and I would say it generally causes issue. It's solvable later, but it does cause problems also.
Okay, great. Thank you. I think what we're going to do now is move on to, I think it's the university section next. We have a lot of a lot of questions about university startups in particular. And this question actually came in, I think, a couple times, was what do universities look for in a license agreement, and what are particularly the biggest turnoffs? And Bill, I know you've particularly been looking at this recently with some other folks, so maybe you can delve into that first. Is there anything in particular about university license agreements that have been seen as problematic from a venture capital point of view?
It depends on the beholder, of course, but, sub-licensing sorts of agreements, there's some terminology there that can be difficult. I think that, I don't know that there's any one particular term that is a problem. It's what's encompassed by it. So, anti-dilution protection, exactly what the numbers are matters. I think most VCs understand conceptually why tech transfer offices want anti-dilution protection. It comes down to what are the terms, what's the magnitude, and how does that play out over time. What the company can and can't do if they decide to sub-license later, because a lot of times, they'll bring in a platform technology and then realize, gosh, we're going to develop it in one area, but we can sub-license it in another area, and how those deals are structured, and where economics flow, who has a claim on what, is a source of, I think, considerable conflict over time. But most of the time it's not the concept, it's how it's translated into a specific deal.
Mm-hmm. Great. Anything you want to add on that, Marc? Otherwise, I'm going to move on to the next question.
No, I mean, we might want to put a plug for our license database that we do at OUP have, a database of license terms, and can be helpful to our partner universities. So if ever you want to get some insight from us, feel free to follow up with Kirsten about that.
Great. So another question about universities and the startups is about the equity that the universities receive, usually in the form of common stock. Should universities ask for preferred shares, and pros and cons on this? Marc.
Yeah, I think it's difficult. So my guidance would be not to. The first reason why is usually at the time you're negotiating that there are no preferred shares. So it's long before a preferred round. So what you're saying is that in the future, when you issue those preferred shares, we want them also. And that becomes pretty significant. So it's difficult to ask for, it's far in the future. And it's also a source of controversy. So companies and company counsel won't generally want to give it to universities, because preferred shares have things like liquidation preferences that give kind of more value to the stock. So while it would be nice to have, I think it is difficult to get, and I think it just increases friction in the negotiation. So I personally would not do that. And if you get a choice between asking for preferred shares or asking for more common or greater anti-dilution protection, I think it's a little easier to get greater anti-dilution protection, or maybe a little bit more equity, than to try to get preferred shares.
Great. This is a question I'm going to ask, and actually it's one we may want to look into later, because I'm not sure we have an answer for it. And it's about recently finishing grad students, about the percentage of companies that we see that are led by grad students in particular, and that we fund. So how many we see and how many we fund. I'm not sure if we have those statistics, but any ideas on that? Marc, I'm going to ask you that. I think you might have on the data.
Yeah, I don't think we have the data now. David Dorsey on the AUP team has done some work around experienced and inexperienced founders, so he may have the information, so we may be able to follow up on this one. I would say in most cases, it's rare for us to fund a grad student as CEO if we're just getting to know them right now. Sometimes we will fund them if we've known them for a year and we've watched them perform. It's one of the reasons we want to get to know companies early. So we actually, in our portfolio, we do have some grad student run companies, and we have some very successful companies that ultimately were run by grad students, where generally we didn't invest the moment or within a month of meeting the grad student. We invested a year later or 2 years later after we watched them perform over time. There are some grad students that have some kind of special intrinsic qualities that allow them to learn really fast, and we're interested in investing behind those, but it's hard to spot up front. I don't know the actual numbers though.
Okay. It definitely, I think it's something interesting for us to look at then in the future too. Bill, this next question's for you. What recommendations do you have for a team with a platform technology to identify or choose a beachhead market? In particular at this university, they teach the customer discovery methodology, but they have to take a guess as to which market to actually dive into first. And then potentially they're leaving those other applications behind. Do you have ideas on how for them to actually choose a set of questions, or how to actually make these decisions on where they should go first? And Bill, maybe I'll have you answer this first, and Marc, if you have follow up on this.
Kirsten, that's rarely an issue in life science. I mean, there's platform technology and like which application would you go after, but it's a very different situation than I think the question you're answering. So it's really a product market fit question, which is more something the tech
on the tech side
focus on. So I'll just punt that one right to Marc, I think.
All right.
Yeah, sure. And let me start with what I recommend a company not do. So what a company should not do is not pick a product. So no one invests in technology, and technology doesn't sell itself. People invest in products, and products sell themselves. And so you need to get to a product. So what you can't do is say, we're not going to try to kind of orient towards a certain product, nor can you try to be too many things, have too many products from a certain technology. And we see that happen a lot, where you do have platform technologies where the entrepreneur wants to preserve all optionality and explore 4 different directions. And generally that's fraught with failure. You don't focus, you waste too much money, it takes too long to try to get to a single product. So we do advocate picking early and picking before you have full data, because you never have full data, of trying to get to a specific product for a specific market. And the more specific you can be early on, the better. Now, the problem is that I think the person said use guessing in the question, and there is guessing involved. Like, it's a combination of in picking, how do you pick what product for what market? There's data, you go out and talk to people, and there's intuition. And intuition really matters here. And so you've got to use intuition and pick and go for it. And if you pick wrong, then 9 months from now, you need to stop and turn. But you are better off doing that than not picking at all, or trying to develop products for 4 markets at once. That almost always fails.
Great, thanks. Bill, when you've worked with scientific company founders, so faculty members who have been company founders, what do you think are the most common misconceptions perhaps that they have, if they haven't done this before in particular, about being a company?
Well, there's a couple buckets they fall into. I think the biggest is to underestimate the time and money required to take a kind of a laboratory discovery to its conclusion, to a point where investors exit, let alone actually bringing a drug to market. And we'll talk about life science now. We all know that takes, a decade plus and hundreds and hundreds of millions of dollars. But if you even back it up to, okay, the investors that are going to put money into this company in its early days, what is the time horizon and the dollar requirement for them to realize that vision? I think there's generally an assumption that it's shorter and faster, and the dollars are less to get there. So really trying to educate founders on how long it takes to really get these technologies developed, particularly if they're drugs, and how much money it takes, the hurdles it takes. And then I think on top of that is the risk at each step. And as you look, and there's publications on this, and there's a literature around it, but the risk of moving from development candidate to clinical candidate to phase 1 to phase 2A to phase 2B, there's a fairly significant dropout rate along the way that I think most academic founders don't fully appreciate. that the probability of just getting your discovery to phase 2 is vanishingly small. And so valuations and capital requirements and unfair capital structures all end up are a consequence of that risk that I think is unappreciated.
Great. Marc, anything you want to add to that?
No.
Okay. So Marc, I'm going to direct this next one to you because I think you've done a little bit of research in this area. For a public university in particular, this person is asking about, I think in general, when they're thinking about starting a fund to provide resources to startups out of the university, but also invest in university programs that feed the university startup pipeline, what are recommendations you have for them in putting these funds together, how it should be governed and managed, how the funds should be distributed, et cetera? Do you have any thoughts on these types of funds?
Sure. The first thing I would say that I think one of the most important aspects of that is defining the mandate of the fund and defining it as to whether the goal of the fund is to make money or separately build the entrepreneurial ecosystem or something else, and to not try to mix those mandates. And so too often we see university funds have mixed mandates where they believe they are both going to make money, but then also heavily build the entrepreneurial ecosystem. And those are often in conflict with each other because building the ecosystem means you're investing really, really early in really risky projects. There's often not a management team there, so the failure rate is high. But what you do is you get lots of companies off the ground and started that might not otherwise have started. And so trying to do both, be a significant kind of return generating fund and significantly build the ecosystem is hard. And so we encourage universities that are thinking about these funds to pick one or the other. And usually we encourage them to pick building the ecosystem. If you can define success as building the ecosystem, and perhaps the fund is successful and then it can kind of fund future innovation down the road, that would be great. But don't start out expecting you're going to have a fund that is going to do terrifically well and do very, very early stage university investing. It's just very hard to do. So that's I think the most important thing is defining the mandate. The second most important thing is figuring out where the money is going to come from. So we've seen the ratio of activity and talk about funds relative to actual funds closing is very much kind of in the camp of the talking about it. So it's really hard to get the money. And it's particularly hard in this environment, but in general, we've just seen most university funds that have tried to go out and raise capital either on the outside or from the endowment struggle to do so. Some have gotten it done, but it is a struggle. So finding the sources of money early is really difficult. And then the third piece is to get outside industry feedback. There are lots of venture firms who will sit on advisory boards of funds like this. We often do, and also industry people, and make sure you do have kind of an advisory board that's helping you pick what to invest in that is composed of outsiders.
Great, thanks. Bill, we have another question regarding license terms in particular, and I don't know if you have any in particular insight on this, what you've heard from other investors, is that they say that they're seeing a trend of investors that take issue with the universities getting milestone payments as further compensation consideration in the license agreement between the university and the startup, and particularly milestones that are linked to clinical or regulatory achievements. Is this something that you've seen as well? Do you have any thoughts on this? Or is this something that you've been hearing about?
I think it's been a feature of that type of license for a long time. And I have, to be honest, I've not heard or seen a lot of pushback on the concept of that term of a milestone-based payment being a problem. It always comes down to how much, but I have not personally seen that a lot of pushback around kind of traditional regulatory milestone connected payments. A couple companies I'm involved with as a director now, we have some payments coming due, and we went through it, we budgeted for it, the money was raised to cover it, and we're going to pay them. So I'm not, I mean, I think VCs are always looking to pay less. Companies are always looking to pay less and license things for less. But I've not seen that structurally as a new area of pushback. Not to say it's not true, I just haven't seen it.
Right, you haven't seen it, okay. Great, thanks. Marc, has there been a scenario that you've experienced or heard of where founders, universities, and venture capital groups partnered up together to decrease the risk of tough tech ventures? So they've been actually working together to decrease the risk and then maybe spin something out of it, I think is what the person is asking.
You know, there have been some coordinated efforts around specific universities and funds, sometimes where the funds themselves have had some capital from venture firms and an experienced person running it, and they have accelerator programming and incubator space, and to try to help companies kind of have a safe space with similar companies to try to improve the odds of success. So you definitely see it in the Boston area. There have been some efforts there around this. And so the answer is yes. Unfortunately, it's tended to be in the more active venture markets. You know, there are less kind of truly kind of big opportunity, big kind of structured opportunities like the questioner is asking about in called secondary markets, but we have seen it in some of the primary markets. I think and they've definitely had individual companies that have benefited from that. So I would say that we've seen success from it, but it does take a lot of capital. So to be able to have money to invest and money to run an incubator and an accelerator and have a staff, we're talking about a lot of capital, so it's hard to pull it off.
All right, thanks. So we have another question on division of, I think would actually be founders' equity split. The question is, if a faculty's technology and technology pipeline is crucial to a startup, what do you believe is a rational equity split between the faculty who's not leaving the university and one or more of the technical founders out of his or her lab? Now, we do have a presentation on this that this person potentially could look at that we'd be happy to send to them, but is there anything beyond that Marc or Bill you'd like to answer? Marc, do you want to go first?
Sure. You know, the key for us is that the equity goes to people who are going to create value in the future. And so sometimes you have, the problem is where you have a founder who isn't going to be that involved in the future, and they think they should get a huge piece of the founder shares today, when in fact, most of the value creating work is in the future. And that becomes a problem. And we've seen transactions blow up because of that. So it's easier when you have a group of founders that are all going to be active in the future, either part-time, they'll stay at the university or not, but everyone feels like their contributions are important in the future. And then there's still a negotiated outcome around that. It's harder when you have a founder who's not involved at all. And in terms of like specific ratios, I would say that there is no market around how, let's say you have an academic founder whose lab it's from, and they're staying in they're going to continue to run their lab, and then you have a grad student who maybe is going with the company, and a couple of other founders who are not going to be going forward with the company. There's no one number to say, how do you split that pie across 4 people? It winds up being kind of a negotiation across those 4 people.
Okay. Great, thanks. Bill, you know, we get a lot of medical device associated technologies that we look at. This particular question is on medical devices. Are there investors who are particularly focused on medical devices that you know of and that you could talk about? Is there anything else that you want to comment on early stage medical devices out of universities?
Well, there are. I think, you know, medical device investing went through a really cool period for quite a while. We've seen some uptick in activity pre-COVID, and I assume it'll be post-COVID in medical device investing. The challenge is it's not been the big new idea, you know, PMA regulatory path, implantable device that is going to take hundreds of millions in a decade to take to market. The activity's been more in incremental devices. And the investment activity has been, in the last 5 or 6 years, has increased around late stage medical devices where, you know, they've fallen on hard times and they're able to invest in late stage companies at early stage prices, or clinical stage companies in recaps. And so some of the activity that you hear about is really investors taking advantage of what's been a very stagnant financing environment. But the brave new world ideas that are going to take so long time and a lot of money, those are still finding it difficult to raise money. It used to be that the regulatory path was the challenge. Now that still a challenge, but reimbursement has become more of a concern, and how you're going to get paid for it, what codes exist, what payments exist. Do you need, develop a new code, which takes years just to do that. So I think the really big new ideas that are breaking new ground are going to still be challenging. There are some groups like Lightstone that have pretty active device investment teams today. And, you're seeing a few more of those develop, but in general, it's still a relatively cool area, particularly for the really big new ideas that tend to come out of university labs.
Right. Thanks. Marc, when we're looking at, possible investments, how does OUP check potential unconscious biases towards founders of diverse backgrounds? I know this is something that we've talked about before, and also then how are we engagements that potentially that we have also had on female-focused funds?
Yeah. So I think it's a great question, and we don't I don't have a crisp answer. I wish we had a specific analytic process that we were able to call out all unconscious biases and we knew them. We don't. I would say that we are sensitive to the issue, and all kinds of unconscious biases, whether they're around gender, minorities, or stylistic unconscious biases. And the main thing I think we do is because we are first and foremost investing in management teams, we have multiple people in the room, and we have active discussions and in particular disagreements on how we think about somebody. And all of us on our team, I think, are kind of independent thinkers when it comes to evaluating people. So some of the most robust discussions we have are around whether we think a management team can be successful or not. And hopefully by the diversity of our team, which is diverse both by gender and by race, and also by the diversity of opinions, we can get rid of a lot of unconscious biases. But I don't think we've perfected that process. I would say that as it relates to female-led opportunities, we are it's been an area of lots of kind of thought on our side. So we have funded a significant number of companies that have female CEOs and our female founders, and that's important to us. And we've also done some work on this. Stephanie Stamen on our team has done some research around female founders, and we did a recent webinar on the exact topic. So by kind of keeping awareness of it up within OUP, hopefully it makes us sensitive to it.
Great, thanks. And I would like to point out our co-hosting of the Equalize 2020 a pitch competition that we hope also to continue to be involved in the future, where we're focusing on academic entrepreneurs. So we are coming really close to the end of our time, despite having gone over a half an hour. I would like to ask a couple of more questions. Bill, there's a question from an attendee about how someone with an interest in becoming an operator in the pharma space can gain experience, presuming they have a baseline business education. Perhaps they don't have that science background. Any thoughts on that?
I mean, operating experience in a venture-backed company, I think, that's going to be hard. I think, venture-backed companies have very skinny teams. We talk about how we focus on the team, but every person on the team, every box in the org chart has to bring something to the table. And I would think to develop operational and domain expertise in pharma is best done at a pharma or big biotech company where they have the resources and infrastructure to train people how to do their jobs. In venture, we're always picking people out of those companies who have the skills already and can come, implement what they know at the startup. But there's very little room for apprenticeship or on-the-job training in a startup. So if someone's looking to develop an operating position at a venture-backed biotech or biopharma, that path almost always has to go through a big pharma or a big biotech company. It's very hard to do it on your own, unless you're the founder, which is possible. But to be hired into a company as an employee, you've got to have that domain expertise already in your pocket.
Thanks, Bill. Marc, a couple last questions. Actually, this person is, I think, kind of asking you guys to put yourselves in the shoes of a university person representing IP. What do you think is a minimum investment range you'd want to see in a venture before actually doing a licensed deal? Is there an investment range, or does it depend on the particular situation? And then I have a couple of follow-on questions to that.
I'm not sure I fully understand the question. Let me kind of repeat back what I think they're saying, which is what's the minimum amount a company would need to raise to make it interesting for us? And is that, Kirsten, is that your interpretation of it?
Let's go that direction, yes, yeah.
Okay, so, the answer in general, to make it not just about OUP, is a question of how big is the venture investors fund? And so what size investments do they need to make to be impactful to their fund? So for OUP, we ultimately want to have about, given the size of our fund, we ultimately want to have about 15 million invested in a company. So if a company is raising a very small amount of money, let's say $500,000 or $1 million, we would consider it if we thought it was a pathway to investing a lot more money later. We wouldn't consider it if we thought that was the only, check we would ever invest in the company. And so, so the answer really depends on the fund size of the investor. So for us, to give you a number, if a company's raising less than $1 million, if it's a tech company, we would want it to raise what's called $1 million. And the reason why is generally that's a big enough check for us. And also it can usually give you the chance to get 12 months down the road or so. The other way we think about it is how much time does that round buy you? And so we want to make sure the round buys enough time. So it would have to be at least $1 million round. But most of our companies are raising on the tech side, if it's a first round, 2 to 5 million. And if it's a life science company that we're investing in, they're generally raising kind of 5 to 20 as a first round.
Great. And just a quick follow on to that. We know a number of universities now are sometimes doing deals that are mainly equity deals in certain particular situations. What strategies would you use to protect against being basically diluted down to nothing by the point that they actually have an exit and the equity is worth something, but having that equity actually be worth something, not nothing, when they get down to that point? Marc.
Yeah, so first and foremost, that's part of why we exist. So what you should have are participation rights in your license. So when those companies raise follow-on capital, we can invest on your behalf in those companies and you can share in our profit. So that is a great way to participate down the road and protect yourself against equity dilution. In addition to that, given the license database we have and all the data we see, I do think, depending on the sector and the stage of the business, I do think sometimes there's the ability to push up the amount of anti-dilution protection you get in a company. So I think it's easier to push up anti-dilution protection. So rather than get protected against the first 2 million of capital, when the company's probably going to raise 50 to 100 million, maybe you can get protected against the first 10 million of capital. And so just given the deals we see, I think that there's some ways to protect yourself against future equity dilution that way. Kirsten, is there anything else you would add to that?
No, I think it was spot on. So I think actually we're going to wrap up now. I think we've answered almost all of the questions that came in. If we did not, if I missed something, please follow up with us. We are very happy to answer your questions. On your screen, you can see the contact information for all of us in case you do have follow-up questions. Before we do run out of time, I'd love to collect information on your feedback for this particular webinar. You'll notice a link in your chat box appearing now. If you could fill this out, we really appreciate it. We do read all of these surveys. We do use this to inform us about future webinars that we'll be giving. That is actually how this webinar came about, was